Hey everybody, and welcome back to H Invests. Today I wanted to take a step back and go through exactly how I value companies using earnings per share and forward PE. I appreciate I've done a lot of deep dive stock analysis on my channel recently, which is really great. I really enjoy publishing my research. But there have been some questions about how exactly I build this model. So what we're going to do today is we're going to go through it in full detail. I'm going to explain exactly what I do, and I'm going to give you guys the steps so you can build your earnings per share valuation models in the future. I hope you guys enjoy the video. So here's me in my last video going through my EPS valuation on Western Union. And for most of the companies I analyze, I do this in conjunction with a DCF valuation. So what exactly are we doing here? It's very simple. This is another great thing about this model is it's very simple to understand and much easier than doing a discounted cash flow. So if you haven't got your head quite around exactly how everything in the discounted cash flow works, this is going to be much easier for you to understand. So we've got the PE ratio, right, which is basically the current share price divided by the earnings per share. So what the PE ratio is saying is how many multiples of the current earnings are you willing to pay for the stock? That's basically what it is. So if you had a price to earnings of 18, you'd be paying $18 for every $1 of earnings. Now what we can do is we can use very simple maths to flip this around, right? When you multiply the earnings per share by the price to earnings ratio, you're then going to get the current share price. You see what I'm doing? So now what you can do is you can say, right, if we can forecast the EPS, which we can, and in fact that's the most forecasted metric in the whole of the stock market, and then forecast the PE, then you can also get a forecasted share price. That is literally exactly what I'm doing. Very simple stuff, using the most common ratio and one of the most common metrics there is out there. This valuation method doesn't work well for every stock. You know, there's no valuation method I found that's worked well for every company, but it does work well for most companies. So companies like McDonald's, Microsoft, Johnson & Johnson, what do these companies have in common? Well, number one, they have relatively stable and consistent earnings, right? Their earnings aren't moving around all over the place. They're relatively mature companies. Companies like Microsoft, you know, they're still growing very quickly, but they're growing at a relatively consistent rate. The other thing these companies all have in common, and is quite important, is they have a large market cap. When a company has a large market cap, there's a lot of research being conducted on that company because there's demand from the buy side to buy the research, and hence there's a lot of analysts trying to forecast the earnings per share going forward, which is very important. So that's the kind of things that we're looking for. Companies that it wouldn't work so well for is Tesla. Like Tesla does have a large market cap, so there's a lot of research on there. But when analysts forecast Tesla's earnings per share, it's often in a very wide range because Tesla has only just got to that point where it's making profit. And whilst its growth might be very fast, it's not very predictable at all. And then you've also got Virgin Galactic, the kind of, we're going to send you to space company, and Canopy Growth, the marijuana company. They're obviously very young companies. So we've only got turnover to work with, right? We haven't got any net profit to work with. And hence it's very difficult to forecast earnings per share going forward. So what we're going to do now is we're going to go through a full earnings per share model. And which company we're going to look at? We're going to look at Coca-Cola. And the reason why I picked Coca-Cola is, look, it's probably the most well-known company in the world. All my viewers would have definitely heard of this stock. It's also an incredibly easy company to understand. So if you are more of a beginner in the stock market and you wanted to try and analyze Coca-Cola's business model in conjunction with doing the valuation, then it'll be much more straightforward for you to do so. I'll see you guys over on Excel. Right, okay. Here we have our EPS on Coca-Cola. The very first thing I'm going to say about this is I do not build my models from scratch every time. What I mean by that is that obviously I'll make improvements in these models if I'm analyzing a new company. But when you are building these models, you don't need to build it completely from scratch. What you can do is just copy and paste everything into a new Excel, and then you can just change the name of it, change all the company variables, and all of these like calculations. You can see like in here, it's like I4 minus H4 divided by H4. That will stay. So that's really, really perfect. Like, it saves you so much time, and it means you can actually build a valuation in about 10, 15 minutes, as opposed to like, an hour if you started from scratch. And what I will do is look at the link in the description. This will be on Google Drive. Just click it and you should be able to access this. Let me know if there's any problems. Now, first things first, you can see turnover on here. Now, why have I put turnover on here when we're looking at EPS? Well, basically, turnover is the core sales of the business, right? With EPS, there's so many different types of EPS. There's GAAP, non-GAAP, continuous, reported, diluted. But with turnover, it's much more difficult for accountants to be clever and manipulate a company's core sales growth, which is exactly what turnover is, right? So you can see turnover and turnover growth on here. These numbers you can just pull from companies' reports or any data source, Yahoo, Seeking Alpha, SharePad, whatever you use. And the same with the forecast. So these are average of analyst forecasts. And then you've got the growth, which I'm literally just doing this calculation for, C4 minus B4 divided by B4. And then you can just kind of drag that across and it'll give you the growth. Then you've got the EPS. So for Coca-Cola, I'm using GAAP, so that's like generally accepted accounting practice. So this is the EPS I'm using for Coca-Cola. You can use any one you want, but I think GAAP is just better, particularly if you're seeing like a large discrepancy between GAAP and non-GAAP over time, like the non-GAAP figures. It's much less strict in terms of accounting practice. So you may or may not see the CFOs starting to, be a bit optimistic with the numbers, let's just say. So you've got EPS here. This is going to be in cents. So by the way, turnover, it has no like bearing on EPS in the model. This is just a completely independent figure. I just put this on here as a guideline. For example, if you've got turnover shrinking and EPS growing, which we have in this case in the last 5 years, that means that Coca-Cola has had to grow its margins a lot. And that's something you need to be thinking about. You need to go into their business model and think, is this sustainable for them to have growing EPS growth in the long run when their turnover is shrinking, right? Down here, you've got the PE. So price to earnings, this is the average price to earnings of the year, and you can see the trend over the past 5 years. This is exactly what I'm talking about. You've got a PE of Coca-Cola that's relatively stable. You have got 1 year where the PE was 88. This was just a bad year for Coca-Cola in terms of net profit, which obviously you'd want to look at in more detail when analyzing the company. But you basically just use this as an outlier. So you can see when I've got average PE here, I've done the average of B10, D10, E10, and F10. I've just completely missed out C10. And the current PE here is 27.3. That's the same as this. And then you've got the discount rate as well. One really, really good thing about this model is the discount rate does not influence the final projections as much as some of the other variables. And in a discounted cash flow valuation, like the discount rate is the main variable that influences the overall target price. Here, the WACC discount rate, it is important, but it's not so sensitive, right? It really, really isn't. So if we change the discount rate from 8 to say 7, you can see our target price has gone from 54 to 56. We're at 56.5 at the moment. We go back to 8%, and now we're just under $55 a share. So I think that's really, really positive. But it is important for you to have a discount rate because like these earnings per share numbers, obviously there's opportunity cost from holding the shares, and the earnings per share next year is not worth the same today as the earnings per share in the future, right? If you had a company that's earnings per share was just flat over a long period of time, you wouldn't say, oh, that earnings per share in 5 years is just going to be worth the same as today. So that is something really, really important to bear in mind. So you can see the discount rate here. So let's just go through exactly what this is. You've got the turnover growth, which is just to highlight a pattern. Then you've got the earnings per share, which we've forecasted from the average analyst estimates. That's this number here. That's why it is in like this beige sandy color, because we've got that from the analysts. And you can see the analyst forecasts here. So I've got mine from Seeking Alpha. This is something that's really, really important to look at. So as I said, number one, what you want is you want a large number of analysts. The higher the sample size, the better. The second thing you want to be looking at is as small a range as possible. So you can see for next year, the earnings per share forecasts from 25 analysts is between $2.26 and $2.39. Is that good? Yes, I would say that's good, because you've got 25 analysts in a really, really small range. So you can say they've got a high degree of confidence that the earnings per share is going to be about $2.30. Right, so let's go back to here. So you've got the earnings per share here, then you've got the growth, which is just the same formula as before. And then what you're doing is putting in the discount factor. So as we know, that's 8%, but it's not just adding 8% a year. That 8% is compounding on itself. So what I'm doing here is I'm doing 1 plus B14 to the power of 1, 1 plus B14 to the power of 2, to the power of 3, and so on and so forth, to the power of 4, to the power of 5. Because you want to discount it by more and more when you're looking more years into the future. So then what you've got is you've got the present value of the EPS. So you can see here, there's not a big discrepancy between that and that because we've only divided it by 1.08. But here, there's a much bigger discrepancy. What we're saying is $3.04 of EPS 5 years down the line is worth $2.07 of EPS today, dividing that by the discount factor. And then what we're doing is we're multiplying it by what we think Coca-Cola's PE would be. As I said, you've got the discounted earnings per share multiplied by the PE to get the target price. And that's literally it. That is the whole entire model. What you can see here as well, which is a massive, massive positive, is that over time, we have, this is basically doing the target price year by year. And you've got very little variance in this. So we actually get this by averaging these out to kind of see what the average target price would be over the next 5 years. But this is very, very stable. So for me, using these assumptions, you can say with a relatively high degree of confidence that Coca-Cola's target price is about $55, which is roughly where it's trading at the moment. It gives you about 3.6% upside, right? And that is literally how we do it. You've also got different metrics in here because obviously, you don't want to say, oh, this is it and this is gold standard, right? You've got different metrics in here to really show you what the growth is in the past and what the growth is going to be in the future. I would always recommend calculating growth in two different ways. Number one, you've got the average growth, right? But number two, you've got the compounded average growth, which is done by doing the final divided by the initial, and then you do to the power of 1 over how many years it's been since, and then minus 1, and that will give you the compounded growth. And really, this is often a better metric if you have this kind of when you have Coca-Cola, it's had this weird year. You don't want to be doing this because what will happen is you have really, really high numbers that will distort the growth rate. Why does that happen? If you have something at $100 and it falls by 50%, it's gone to $50, right? But in order for it to get back up to 100, it has to grow by 100%. So that's why when you get this large variance, you're going to see an average growth, which is the average of that, distorted to the upside, and then you've got the compounded average growth rate is much lower. But you basically just need to look at the trend. You don't have to have these numbers in here. You basically just want to be looking at the trend. And you can see, as I said, turnover growth is downward, but you see a big rebound from the analyst, which is quite interesting. That rebound is consistent with earnings per share growth. But what you've got to remember is in the past 3 years, we've gone from 149 to 207, which is actually okay. It's 11.58% EPS growth, right? But you've got to remember that Coca-Cola achieved that with turnover going down. And you've got to ask yourself, when analyzing the company, is that right? Are Coca-Cola going to be able to support higher and higher margins when their margins are already so high? And then what you also want to do is obviously compare the past to the forecasts and check that the analysts are being realistic. I would say the analysts are being very, very optimistic in terms of turnover growth here, particularly when the turnover has gone from 42 billion to 33 billion, and now they're saying, oh, it's just going to rebound to 42.5 billion in the next few years. I haven't done a deep dive on Coca-Cola recently. There's a stock analysis on Coca-Cola from back in March on my channel, but you want to make sure that the analysts have really, really good reason for such a strong rebound in turnover, and that would be supported. If it's true, then that will support these growing EPS numbers. But if you don't think the increase in turnover is supported, then what you want to say is, right, is Coca-Cola going to support higher and higher margins? Because how else are they going to get higher EPS growth when their top line isn't growing? So that's the kind of thing you want to be looking at. And then what I'm doing down here, if you look at this matrix, I'm basically just manually inputting all of these numbers from this. This is a very, very basic version of what we saw up here. And you have the base 2020 growth in there, and you say, right, what's the discount rate? As I said, we're holding that constant. It has very little influence over the outcome of the models, but it's just important to discount it, right? How do you know which discount rate to use? You basically just say, well, the average of the long run stock market is between 9 and 10%. Is Coca-Cola more or less risky than that? A business like Coca-Cola, it's less risky. It's non-cyclical. People have been drinking it for 100 years, and it's not going to go away anytime soon. But at the same time, it has faced a lot of COVID headwinds, right? People aren't going out to restaurants so much, and Coca-Cola's revenue is down a lot in 2020. So I think a discount rate of about 8% is much more appropriate. If we hadn't have had the COVID headwinds, I'd maybe use 7.5%. But it's still probably lower than the general overall market because Coke is a relatively stable business. So we've used 8%, but as I said, it's not the biggest factor. And then your two variables for these matrix are going to be EPS growth and PE. The one that's actually most sensitive is PE. So you've got to say, okay, where are Coca-Cola going to grow and what is the PE going to be going forward? As we saw, the PE was in a range of about 22.5 to 27.5. So we're kind of using this as our bull and bear case for PE, 22.5 being bear, 27.5 being bull. And then you've got to try and work out, where do you think the growth is going to be? I think 12% growth, which is what the average analyst is kind of forecasting going forward, is very optimistic given the COVID headwinds and also given the shrinkage in turnover growth, right? But what you've got to remember is baked into this growth is the bounce back from 2020, because obviously Coca-Cola had a very bad year in 2020 because of the lockdowns, right? But if you exclude that, then they're only growing at 7%. So basically what this is, if we just go up for a minute, this is the average growth excluding the rebound, and then this is the compounded average annual growth excluding the rebound as well. But they're also forecasting a very similar number for turnover. So what do we say? Okay, so this is about 8%. So let's say, right, this is the fair case scenario if it grows like this. If the analysts are right and we are going to get such a big rebound and the turnover is going to grow as well, because some of that EPS growth must come from a turnover growth, right? It can't all come from margins. And obviously they're forecasting turnover growth, so that's where they think it's going to come. As I said, you need to analyze the business qualitatively as well to determine whether you're comfortable with these numbers. But we'll say, yeah, bull about 12%. I like to stagger these numbers roughly evenly. You don't have to do that, but I just like to stagger them like that for consistency purposes, and the same with the PE. So literally all you do, for example, let's say here, it says Coca-Cola has a target price of $28.6. Then you're going to put in here PE of 20 at no growth, and you can see here you've got the $28.59. That is literally how it works. And then what you also want to do is I've color coded these using conditional formatting, and it's given us the upside and the downside on the current share price. So based under all these scenarios, this is how it's going to look. So you can see for Coca-Cola, it doesn't look particularly good anymore. Green is more than 20% upside, because I think when you have more than 20% upside, particularly with a company like Coca-Cola, that definitely gives you enough margin of safety to invest. Amber is yeah, we could invest, but 0 to 20% upside is not a high margin of safety. And obviously you can be wrong in these models. It's not so much about getting an exact value, but it's about getting a range. And then for that range of intrinsic values to be much, much higher than the current share price. And then you buy at the current share price, wait for it to go to intrinsic value, and then you sell it when it reaches intrinsic value. And that's exactly how value investing works and how you make money. So it doesn't look particularly good for Coca-Cola. It looks all right based off these very optimistic analyst estimates, but it doesn't look so good for the stock. If they miss that 12% annualized growth, or even if they miss their 27.5 PE, even at 12% growth, missing the 27.5 PE, they are still overvalued at current share prices. What you can also do is you can implement, what would the stock have to be to turn this green. That's the quickest way to interpret. Like, you want everything inside your box where saying, oh, this is the most likely scenario. You want that to be as green as possible, right? So if we said, okay, if Coca-Cola falls to 45, yes, we have a little bit of green in there, but we don't really have a high enough margin of safety. If we see a massive stock market crash and it falls to $30, wow, all of a sudden it's all really green and Coca-Cola looks like a really good deal. But then, of course, what you need to do if the share price falls so much is you want to check if the stock's expectations have changed or if it's just being pulled down with the systemic risk of the market. So that's basically how you use this model, and I've given you a good interpretation of Coca-Cola and its current value as well. I hope you guys enjoyed the video. Please let me know any questions in the comments. As I said, I will attach this in a link and put it on the drive. And yeah, any questions, please let me know. All right, guys, take care. I'll see you in the next video.